It's the 12th of May. You're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Baig, Chief Economist. Welcome to our 12th episode. Today, we will connect with Washington, D.C. to get a sense of the role the United States is playing or not playing in this global pandemic. We will delve into some of the critical policy measures with international implications put in place by the U.S. Federal Reserve in recent months. We will also try to understand what multilateral organizations like the World Bank or the IMF, both of which have their headquarters in DC, can potentially play in easing the economic and financial risk stemming from the COVID-19 outbreak. To talk about all this and more, we have the distinct pleasure of having with us Dr. Robert Dohner, who recently completed a career of 20 years at the US Department of the Treasury, where he served in 5 successive administrations. Bob's last position was as Deputy Assistant Secretary for International Economic Analysis and Senior Asia Advisor, where he provided advice on the global economic outlook, emerging economic issues, and strategic direction for international affairs at Treasury. Previously, Bob was Deputy Assistant Secretary for Asia, responsible for the region extending from Pakistan and India all the way to China, Korea, and Japan. Bob, it's a real pleasure to have you on Kopi Time.
Well, Taimur, thanks very much. It's a real pleasure for me to be here.
Great. Bob, I'd like to begin with your recently published and really excellent Atlantic Council article. In it, you illustrate the contrast of lack of U.S. political leadership in dealing with the pandemic at the global level against an energized Fed taking actions to ease U.S. dollar funding conditions worldwide. I'd be grateful if you could walk us through your arguments.
Sure. Let me start first with the problem. Even though the current situation didn't start out as a financial crisis, it very quickly took on some of the same characteristics. In particular, there's a huge increase in desire for cash, either to make required payments when revenue was falling or absent, or to avoid falls in asset prices. You, I think, quickly saw a seizing up of credit markets, lots of demands to borrow, few willing to lend. And in this situation, central banks around the world stepped in, extending credit, buying assets. In the United States, the Federal Reserve made huge purchases of Treasury securities, mortgage-backed securities, commercial paper, and have set up a program to purchase corporate bonds. But there's one big potential gap. There's a huge market for offshore U.S. dollar lending, lending by non-U.S. institutions to non-U.S. borrowers. There's over $12 trillion of dollar assets of non-U.S. banks, and almost $7 trillion of bonds issued by non-U.S. entities other than banks. And in fact, if you look at international transactions, about 80% of all of global trade is financed with dollar credit. Now, in this offshore market, there's no clear backstop, no lender of last resort. There are ways to raise dollars, but they're very expensive in a crisis, as lots of emerging markets know from sudden stop episodes in the past. The risks you have here are a worsening crisis outside the United States, sharply depreciating currencies against the US dollar, and a spilling over and worsening of the liquidity crisis in the United States as people outside the US scramble to obtain dollars. The same problem existed prior to the 2008-2009 financial crisis. It affected European banks that led to subprime borrowers primarily, but also affected Korea and other Asian countries. Despite the episode during the global financial crisis, 2008-2009, the offshore dollar market continued to grow and is now significantly larger than it was prior to the previous crisis. This March, the Federal Reserve stepped in, basically compressing the actions that they had taken over the course of a year in 2009 into a couple of weeks this March. They re-energized the Fed re-energized the swap lines that they had with 6 major central banks, And they also reintroduced the swap lines with 8 other central banks, both advanced and emerging market CBs, but for a total of only 14 swap lines with foreign central banks. But in addition, the Fed took another step, and it's a step that's potentially very important. They introduced a repurchase or repo facility for foreign central banks. Under the repo facility, what the Fed calls FEMA, a foreign central bank sells US Treasury bills or other eligible securities to the Fed, and they get dollar cash in return. But the sale involves a commitment to buy those securities back sometime in the future. This is a transaction that's essentially zero risk to the Fed, since it holds Treasury securities, which is what it holds normally. But it opens up dollar liquidity facilities to a much larger number of central banks that hold US dollar reserves. You can think, for example, India, Ireland, Thailand, Taiwan, but also significantly China. No matter what policymakers say, any action sets a precedent. And the Fed has stepped in twice to support the market for dollar credit outside the United States. This has helped backstop the global economy while also supporting the U.S. economy in the process. The implicit promise of support from the Fed in a future crisis increases the attractiveness of using U.S. dollars. And the repo facility increases the attractiveness of holding dollar assets at central bank reserves because you can easily convert them into cash. So as you started out in the introduction, in a crisis in which the U.S. administration and the G20 have been noticeably absent, the Federal Reserve, with little fanfare, has stepped forth as a major international actor. As I said in the paper in conclusion, you can still argue whether the United States remains the indispensable country, but it's clear that in a crisis, the Federal Reserve is the indispensable central bank.
Absolutely. And already in our backyard on the 22nd of April, we saw the Hong Kong Monetary Authority, which isn't bereft of dollar assets, but I think just as a demonstration, a signaling effect, announced that they will utilize the FEMA facility up to and borrow $10 billion. Do you see more evidence beyond the HKMA example already that it is having a galvanizing impact on central bank liquidity positions?
There are a couple ways to answer that. The first is the HKMA borrowing, if it takes place, or the repurchase, would be the first use of the facility. In contrast to swaps, it's a little bit more expensive. You give up a dollar earning asset, and there's a small charge to make use of the facility. So far, no one has utilized the FEMA facility. But in a way, that's an indication that the liquidity crisis in the dollar offshore market has receded, because a standing facility that's somewhat more expensive, but is definitely a backstop, is out there, available to a number of potential borrowers, but not yet used.
Right. And I guess we could say that the way the LIBOR OIS spreads have come down over the past month or so, and the way even sovereigns like Indonesia have had tremendous success issuing billions of dollars worth of debt, means that at least for the time being, the sort of panic that we saw, or the sudden stop that we saw in March, has receded. But it's good to have this facility, as you correctly say, that to make it available for basically de facto the entire world, including the Chinese, is a very strong demonstration effect. I want to talk about, in a moment, the role multilateral organizations can also play in global liquidity. But before that, since we're talking about the Fed, Bob, I want to move on to this point that MIT's Ken Rogoff has been making, and has been creating a lot of ripples in the financial markets, which is that if indeed this pandemic-related slowdown and recession deepens, the Fed could and should consider taking the Fed funds rate down to negative territory. And I think Professor Rogoff rather provocatively talks about a minus 3% target. Do you think that this is, both from an economics perspective as well as from a political economic perspective, feasible?
Well, it's certainly feasible. Let me talk about negative interest rates in the United States. And I think when you talk about negative rates, you're really talking about two flavors of rates. The first is the negative interest rates that have been adopted by Sweden, the Bank of Japan, and the ECB, down to about 0.75% negative, which seems to be the effective lower bound at this point. And the second flavor is Ken Rogoff's deep negative, minus 3% or even more negative for a level of interest rates, where you really have to take actions to rule out large holdings of cash as an alternative to maintaining deposits at negative rates. In the United States, I think the two flavors are respectively unlikely and deeply unlikely. I think the first flavor, the negative interest rates, the kind that Sweden and Japan have adopted, could come about in the United States if there's a plunge into deflation. But otherwise, I think it's pretty unlikely. In my reading of the evidence, there's neither a compelling case for nor a compelling case against negative rates. But the Fed under Jerome Powell has clearly indicated that they're not inclined. They're inclined against adopting negative interest rates. He's answered this question a couple times. Negative rates in the United States may actually require changes in the Fed charter, because the charter explicitly allows the Fed to pay earnings on its deposits. But there's nothing in the charter that says that the Fed could impose charges on deposits with the Fed. And there would certainly be a court case if the Fed decided to adopt negative interest rates. It's also awkward for the United States, the way the U.S. financial system is set up, particularly the importance of money market mutual funds, which is, I think, a $3 trillion industry and underpins the commercial paper market. It's difficult to avoid situations in which a money market mutual fund would be forced to break parity or break the buck on its liabilities on depositors' holdings. Also in the United States, you've got a very powerful, politically powerful financial sector that would, I think, oppose negative rates, not just the money market mutual funds, but also banks and financial institutions more broadly. And the last reason I think that negative rates are unlikely is kind of a sense that I've learned to trust over my life, and that is that negative rates crosses an American libertarian red line. And I can sort of imagine a reaction, which is, quote, I get to keep my money and the Fed and banks can't take it away from me. And that's likely to be a sense that's held deeply on the right and probably even on the left or more broadly in the American political spectrum. So I think those are the obstacles to negative rates of any kind in the United States. The deep negative rates, I think Rogoff is correct to point out that there are potential problems with extensive Fed and government lending, credit allocation, and credit guarantees. And those problems will get worse and more difficult to sort out the longer the crisis lasts and the more difficult it is to restart economic activity. But at the same time, I don't think that negative interest rates even deeply negative interest rates solves the problem of credit markets seizing up. Um, the U.S. economy, other economies, face extensive needs for credit to get through the period of shutdown that go all the way down to the smallest corporations. Um, Even negative interest rates, wouldn't solve the risk aversion problem and the institutional problems of getting credit available to the wide spectrum of firms that require it.
So, Bob, from your perspective, if indeed we're dealing with deepening demand contraction, your prescription on the policy side would be more fiscal policy and perhaps even debt monetization from the Fed side as opposed to negative rates?
So I think we've reached near bottom, but I think the recovery is going to be awkward and halting, particularly if there's a reoccurrence of infections. Um, there'll be a continued need for credit and a continued need for the extension of the kind of programs that have already been put in place. I think there's going to be increasing shortfalls at the state and local level, which provide most of the medical services and face the most difficult fiscal challenges because they often have balanced budget requirements. And I think the difficulties and the political opposition to the kind of measures that were undertaken and the large volume of expenses. In fact, I was adding it up. In fiscal policy, we've already committed $3 trillion to deal with the COVID-19 crisis. I went and looked back. The U.S. participation in World War II cost the United States in current dollars today, about $4 trillion. So we're dealing with a massive response on a fiscal scale that causes problems, political problems in any country where it takes place, and it's certainly in the United States.
Right. This is, I suppose, the big challenge going forward, that having front-loaded such a massive support package, will there be political appetite from the electorate side to go even deeper in the coming quarters if indeed the recovery turns out to be halting and there's demand for more support measures? Bob, I'll share with you one anecdote about the shallow negative rates with you. A couple of years ago, I was in Geneva, and a money market fund there was telling us that the way they advertise their negative rates is as follows. They say it costs 80 basis points to park €1 million physically in a vault. The money market charges only 40 basis points. So the bankers have found ways to make it appealing to keep money in the banks or in the money market funds.
I'll share an anecdote as well. One of the problems that the United States would face, and a relatively easy way to earn a zero interest rate, is that many people make and anyone can make estimated payments on their federal income tax, starting basically a year in advance. And individuals in the United States or companies in the United States could make very large overpayments up to a year in advance on estimated taxes, and then get a refund a year later when taxes are due, basically for the full amount of the overpayment. Or they can roll the overpayment into the next year's tax liability. So until the tax laws are changed, the U.S. Internal Revenue Service offers a zero interest rate on your deposits, in contrast to what banks would offer in deeply negative interest rates.
Okay. Bob, let's go back to the international aspect. So you're in Washington, D.C., IMF and World Bank are there. And the IMF, I'm on their Facebook feed, it seems like, are announcing one program a day for developing countries of the world right now. What sort of innovative role would you like the multilaterals to play at this juncture? Or do you think that the playbook that we sort of refined during the 08-09 crisis is sufficient?
So I've been impressed by what the fund, the World Bank, and the regional multilateral development banks, or at least the ones in Asia that I know, have done so far. And I guess I've been disappointed, but not really surprised by what they have not been able to do. The fund pledged up to $1 trillion in lending to deal with the COVID pandemic. The fund has received requests from over 100 countries, and they've gotten rapid credit facility lending out to 52 countries, totaling about $17 billion. They've also gotten debt service relief out to 26 countries, totaling about $230 million, a much smaller figure, but an important one, I think. The bank has already rolled out about $2 billion in a first set of projects to 25 countries, and will provide up to about $160 billion in other lending. The Asian Development Bank has come up with $20 billion in coronavirus rescue, and even the Asian Infrastructure Investment Bank has come out with a $10 billion facility. One of the things that's impressed me, because I think it's finally a turn towards good policy, is that both the IMF and the G20 have responded with a debt service moratorium, basically saying that borrowers don't have to make debt service payments for a period of 6 months to a year ahead. And this, I think, this caught my attention because in the past, the emphasis, or at least the demands, would have been on debt moratorium or debt forgiveness. But in a crisis, countries need funds right now. And a moratorium on near-term debt service payments is an easy and relatively inexpensive way to free up money right away. If you think about debt service, what you're really saying is, congratulations, you won't have to make your debt payments next year, nor will you have to make your debt payments for the following 8 years, to which the countries rightly say, but I'm in a crisis. I need funds right now. I think the failure to come up with an SDR allocation in the last bank fund meetings was a missed opportunity. The U.S. argument that an SDR allocation goes to the countries, most of it goes to the countries that need it the least, is correct. But in a situation in which the Treasury, the administration, and other G20 countries were determined, that was a problem that they could have solved. They could have solved it through reallocation or loans back to the IMF for the IMF to use in facilities. The second thing that's kind of disappointing is that institutions lean back on what they know and the facilities that they've already created. Some of the rapid credit facilities, in particular the new IMF short-term liquidity line, is still very heavily geared towards countries with very strong fundamentals. A former boss of mine, Ramin Taloui, who's now out at Stanford, has argued that the fund should have adopted a kind of sliding scale to make percentages of quotas available to a variety, the full range of IMF members on a very quick short-term liquidity basis. The institutions are moving rapidly. they're facing countries are requesting money from whatever pools or pots are available. There are sure to be coordination problems among the institutions. Certain to be a kind of fog of war atmosphere as each institution tries to rapidly expand its activities. But that's sort of the cost of responding in large amounts in a crisis.
That's right. A couple of podcasts ago, I was speaking with Raghuram Rajan, who now has been appointed as an advisor to the IMF from the outside. And his view, to the point that you're making, is that perhaps there could be a temporary extension of quota for a select group of countries. And so it becomes like a de facto swap agreement. And within 6 months, the country cannot handle it, then of course they go into a conventional program. But for the first 6 months, they get the emergency cash that they need so acutely.
I think that's right. You can think of it as the IMF program is the fund's backstop to a rapid credit facility or rapid credit line to a country where the fund faces more risk.
That's right. Bob, you spent a large part of your career focusing on Asian economies, so we have to talk about your perspective on both the more advanced parts of the region, so the Singapore, Hong Kong, Taiwan, Koreas, and then the emerging part of the region, which saw massive capital outflows, particularly India and Indonesia. Now we are at this very critical juncture where lockdown is still in place in most of Asia, with the notable exception of China, Korea, Taiwan, but there's still some uncertainty there as well. But do you think that there is a small glimmer of hope that Asia, while facing very poor external demand from the rest of the world, could benefit from, say, some revival of China's domestic demand as well as low energy prices?
Oh, sure. I mean, to start, the COVID-19's effects are so large that no country is going to come out of this unscathed. So you're really talking about which country, which economy deals with an awful situation better. I'm actually more optimistic about the Asian countries broadly than I am about other parts of the world, even in many cases the advanced economies. And like everyone, I've turned into an amateur epidemiologist as I've tried to understand the current situation. I think the thing that strikes me is, sort of notwithstanding what I will say later about the dependence on trade, I think the countries that will do best economically will be those that were most effective at dealing with the pandemic. And one of the observations that's fairly easy to make is that the Asian countries and also some African countries, countries with experience of SARS, H1N1, and dealing with Ebola, have been the ones that have been best prepared and also took actions the fastest to deal with the pandemic. The countries that do most well, I think, have relatively cohesive societies with confidence in their governments, and it characterizes many Asian economies, probably many North Asian or Northeast Asian economies. These same characteristics, experience, preparedness, and relative cohesion, make countries best able to deal with a crisis, and I think give them a clear advantage in coming out. The ability to identify cases, trace contacts, do selective quarantines. Countries in Asia differ a lot in income levels. Poor countries with relatively weak healthcare systems will be especially challenged. But these countries also tend to be significantly younger and thus have lower fatality rates. If you look at the fatality rates across ages, it's almost non-linear at about between 55 and 70.
Right.
As you mentioned, the capital outflows have been very large and very fast. Uh, Once again, the countries with large foreign exchange reserves and large current account surpluses have fared better. I spent a good part of my career telling Asian economies that they ought to reduce current account surpluses and they ought not to build up such large foreign exchange reserves. But the experience of the Asian financial crisis, the global financial crisis, and the current crisis mount a pretty strong argument that more reserves and a current account surplus position is better. Also depends on the fiscal space that countries have. I think the economies in Asia that are pretty well positioned, you've mentioned Korea, Hong Kong, Singapore, Taiwan, and Thailand. I think it's going to be more difficult for Indonesia, India, the Philippines. Malaysia is somewhat in the middle, fairly large fiscal deficit, and also Malaysia is a net oil exporter. Lower oil prices will help most economies in the region, but it's only about 2.3% of GDP, oil imports in emerging markets. Sometimes that's absorbed by fiscal systems because you've got a controlled domestic price. Sometimes it's absorbed by exchange rate depreciation. But I think on the whole, it will be a benefit. Lower oil prices will be a benefit for most economies in Asia. One last thing that I'll mention before I get to trade. Tourism is a big vulnerability. JP Morgan had a really nice table on the contribution of GDP from tourist receipts. It was almost 23% in Thailand, over 20% in the Philippines, and about 13% in Malaysia. And the last factor is trade. Exports are about 25% of GDP in Asia. Not all value added, but still exports play a very large role. And trade is going to plunge this year. The WTO forecasts the trade will drop somewhere between 13 and 32%. So how fast the rest of the world recovers, and particularly for the region and especially for Northeast Asia, Japan, Korea, Taiwan, how fast China recovers is really going to be important for the Asian economies. But on the whole, my expectation is that Asian economies will be hit badly, like everybody is hit badly, but will prove relatively resilient in dealing with and coming out of the crisis.
Right, Bob. I mean, that is the heart of our concern as we go through this pandemic, which is that, there will be increase in credit risk. There will be loan losses mounting in the financial system. But the fact that most large Asian banks are well capitalized, have good buffers, and have not necessarily engaged in aggressive lending strategies in recent years, and we don't have that many housing bubbles in the region, so the risk of a bust is not that great. Hopefully, those factors play into the role of allowing us some buffer or some resiliency. But like you, I do worry about India and Indonesia, not just from the fact that their public health provisions are limited. The thing that worries me is that while they've had a headline pickup in reserve numbers, but their external liabilities have also gone up substantially. So, yeah.
Well, yeah, I mean, that's, in a sense, though, that's what you would want. Both the ability to borrow in a crisis and the actual use of borrowing capacity in a crisis. Everybody's taking on more risk, and the question is really who's relatively well poised or situated to take on that risk. And my sense, although I haven't examined individual countries closely for some time, is that most Asian economies are are pretty well situated. They have relatively strong banking systems. China is always the question mark here because China credit growth has been very rapid. There's been lots of financial innovation that has increased financial sector risk. There's a soft budget constraint, and at the same time, there's a implicit but substantial government backstop. So everybody who deals with China, who examines the Chinese financial system, basically says, well, yes, there are considerable risks, but on the whole, we think the government will cover them if necessary. And it's a bet on both capacity and speed and effectiveness of reaction. I still think I'm on the side of, yes, they will deal with it if the need arises, but my variance estimate or my sense of risk is still pretty large for the Chinese financial system.
That's absolutely our concern as well. Bob, that is a perfect segue to my last query. This festering China-US antagonism on so many fronts. Give us a sense of how Donald Trump will deal with China in his second term versus the way a Biden administration would.
Okay, so let me give the answer in three parts. One is, I think this year, the relations between the U.S. and China will continue to worsen, and they're worsening quite rapidly. That's a result of domestic considerations on both sides. For President Xi, it's a matter of maintaining internal support in the face of considerable criticism for failure to respond quickly to the new infection, and some actions, I think mostly by local officials, to hush up and avoid reporting of what was taking place. Domestic nationalism is often a card, and a pretty valuable card to play in this situation, and I think the President Xi has done that. The problems for President Trump are a mirror of that. The fact that the United States was late in responding and has also been floundering in its response has led the Trump administration to blame China for the disease and to use anti-China as a strong part of its re-election campaign. But even though relations between the two economies are worsening, this has been going on for a long time. And the Trump administration was an accelerant, but not the cause of the worsening. At the end of the Obama administration, there was a clear darkening of views towards China and a more confrontational approach by the administration that would have characterized the Clinton administration if there had been one, although Trump took it farther and faster. There is now a rare, because it happens so seldom, a rare bipartisan agreement in policy circles that the United States should take a harder and more confrontational line towards China. And that will persist, whoever is elected president, Trump or Biden. I think Biden would continue the confrontational approach on trade, although would not be an instigator of additional tariffs. Although I think the tariffs are going to be very difficult to roll back. The Biden administration would involve international allies to a far greater degree than the second-term Trump administration. It would not be an America First administration. And kind of avoid saying this because I've been a lifelong Democrat, but I also think a Biden administration would have a more coherent policy towards China, a less variable and less erratic policy towards China than the Trump administration has had. But the general outlines of the policy, a harder line towards China, a harder line on trade, and also I think efforts to decouple the two economies, shorten supply chains, make them more resilient, and move supply chain activity, particularly for pharmaceuticals and medical equipment out of China, would continue whoever is elected president.
Yeah, Bob, I hear you, and I think that this is a very likely narrative, independent of the outcome in November. But I've been discussing this issue of efficiency versus resiliency with some colleagues. The view is that we've had this golden era of companies looking for the most efficient outcome by outsourcing and sending supply chains abroad, and now it's time for more resilient infrastructure. I think that sort of makes sense in the heat of a pandemic, that everybody wants to have a more resilient supply chain. But when the dust settles and the efficient companies are cheaper, I wonder if the argument for a resilient infrastructure would fly in the long run. But that's perhaps a conversation for another day, if you will be so kind to come back to our show.
Right. That's that. I think that's a good point. The other thing that strikes me is after major events, if you think 9/11, think the global financial crisis, and I'm sure after the COVID pandemic, the United States has started major campaigns, the war on terror, financial reform and regulation. And I'm sure that there will be a variety of campaigns, activities on pandemic virus preparedness. It will be hard not to have supply chains caught up in that activity, even if a sort of a clear and thoughtful considerations of the costs and benefits would indicate that the dispersed supply chain is a relatively efficient and relatively resilient supply chain as well.
Oh, spoken like a veteran of these crises. And, we have you back in the government to serve the U.S. at times like this, Bob. But thank you very, very much for a highly informative and insightful set of perspectives.
Oh, it's been my pleasure. Thank you very much.
Thank you again. Thanks to our listeners. You have been listening to Kopi Time. Thanks for joining us. You can find all our publications and multimedia by Googling DBS Group Research.